for joining us here. You're watching Business at 9 and I'm Nivedana Prabhu. Let's begin with the aspect that we discussed, the 2025 Jackson Hole Economic Symposium, where Federal Reserve Chair Jerome Powell, in his address, spoke on labour markets in transition. In fact, he signalled a cautious approach to monetary policy, balancing persistent inflation above the 2% target with a softening labour market as unemployment hits 4.2%. Now, with markets eyeing a September rate cut, Powell remained non-committal, emphasising data challenges and central bank independence amid political pressures, but also dropped in some positive hints. We will listen into what he said, but before we listen into what he had to say, given the particular situation, let me take that across to my colleague Varun Dubey, who in fact was tracking this development for us earlier today. Varun, a very good evening. Given what you had put in terms of what we'll be expecting, that is one aspect, but with what has been said now, how are we looking at this and what are the key takeaways, Varun?
Definitely. So when we went into the, Jackson Hole Symposium, it was definitely a hawkish tone which was expected from the Fed. But if you look at the tone of the Fed, it is more dovish. And now, if you look at the overall tone, it is suggesting towards an interest rate cut in the month of September. Because if you look at, Powell's speech, he has, highlighted about shifting balance of risk, which may actually warrant adjusting policy. He also said that labor supply has softened in line with the demand, and the situation actually suggests downside risk to employment are actually rising. In fact, Powell also indicated preemptive moves may be needed if a tight labor market actually threatens overall price stability. The effect of tariffs on consumer prices are now clearly visible, and it is expected that the effects to accumulate in the coming months also. And it is also possible that the tariff-driven upward pressure on price could actually spur a lasting inflation dynamic, but it is unlikely given the downside risk to the overall labor market. So if you look at the overall commentary of the Fed, it has unanimously adopted a new policy framework of flexible inflation targeting, removing the previous makeup strategy. And actually, if you look, that is highlighting towards an interest rate cut in the month of September, because before going to the Jackson Hole Symposium, traders were expecting 75% probability of a rate cut in September. But if you look at now, traders are now expecting a 90% probability of Fed rate cut in the month of September. And that's the reason you're seeing US markets actually Dow hitting, all-time high. Even the Nasdaq and S&P are up. The gold prices are up. And the overall bond prices, if you look at them, they are seeing a sharp fall of around 1 to 2%. So it's definitely
the implications. When you're looking at these numbers also, in terms of Nasdaq and S&P 500, you're absolutely right. We're looking at that as well. But taking you back to what you were talking about, the bonds, and putting that into perspective, we're given to understand that the bond yields have fallen, but the gold price, on the other hand, has jumped. How are you reading into that?
So if you look at the overall market, so it's a risk-on trade which is actually back into the market. Because if you look at before this, it was a risk-off trade because people were expecting no rate cut, a hawkish tone from the Fed. But now when the tone has actually changed, that's the reason you're seeing money coming back to gold, money coming back to equities. So it's a risk-on trade which is back into the market, and people are expecting rate cuts, and that's the reason you're seeing the overall bond yields in the U.S. market falling. And it's not only the 10-year bond yield, it is the 2-year bond yield, actually, if you look, which has fallen by around 3%. So people are expecting a rate cut in the month of September, and that would be followed in the coming policies as well. So it's a risk-on trade which is back into the market.
All right, Varun, I appreciate you joining us on the broadcast, putting that into perspective for our viewers, and more importantly, what more can we understand from that particular tone that has shifted, given the implications that we're looking at in short term as well. But for the moment, we leave it to that. But since we did tell you that we're going to put into perspective what Jerome Powell had said, not just on the labor market and the effect of tariffs on prices, so let's listen in quickly to the same.
The labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process.
All right, that was, of course, the reaction that has come in. But how are we essentially also reading into this more? My guests join me this evening. Let me take that opportunity to be introducing them. Anurag Singh, Managing Partner at Sid Capital, Chicago, as well as David Ross, Strategist at Quantum Strategy. Good evening to the both of you gentlemen. Thank you very much for taking the time out and joining us here this evening on ET Now. David, let me begin with you. Given, just listening to what he said as well, it has been framed as the labor market as in a curious balance. Is this Fed speak for a soft landing or the first admission that growth is slowing more than expected?
He really said is, look, it's a curious balance because supply and demand are both subtracting, going down in terms of their growth rate or in absolute terms. So both the supply of labor and the demand for labor is going down. And what he says is, if, for example, the labor supply was to stabilize, but the demand for labor was to continue to fall, then you would have a dip into a much higher unemployment rate, a much higher degree of underemployed or unemployed labor, which could threaten economic growth and threaten ultimately recession. And then he said, okay, to balance that risk against the risk of tariffs, boosting inflation. And he says that's not going to be permanent. In his view, that's where he comes down. He argues both sides, but he comes down. Tariffs are not going to boost inflation permanently because the way the labor market, which he has just described as being curious, in a curious balance and fragile, is not in a robust enough condition to pass on those tariff increases, those increases in prices, in terms of higher wage rates. So he says, therefore, the risk of tariffs is somewhat reduced in the risk to the labor market. And he's talking about risk, the balance between supply and demand is greater. And therefore, our policy is in restrictive territory. And we should shift the balance of risk towards adjusting our policy stance, which basically means lower rates. That's the sum of what he has said. I would disagree with practically every line of it, but that's another story.
All right, David, as you pointed out, I'll come back to you to discuss why you think so in terms of your differing view as well. But in a nutshell, as you put those opening remarks, Anurag, thank you also for joining us and for being patient before I had the opportunity to come to you. Anurag, for India, does Powell's acknowledgement of a rising downside risk to employment suggest global growth that could undershoot, or does that change your view on certain sectors?
Global growth has been on a slowdown for the last, I would say, even in the last decade. And if you remove the pandemic surge for the moment, global growth has been, in general, been slowing down for the last 15 years as a trend, right? So we should not be surprised because most of the global growth was contributed by the rise of China. That was the phenomena. And when China kind of adjusts to the new normal, which is 4-5% of growth, because after all, it is a large size economy now, I think we should expect that the globe is not growing as fast. So that's kind of that big picture number there on global growth. In terms of impact to India, Nivedna, my broader sense is that India is not so much an open economy. I understand markets growth rate has strong correlation with the global growth, but most of it is, to my opinion, incidental. But India, while benefiting from the exports and the globalization in the last decade, more than anything else, India depends on its domestic population and the median age being 29 to 30. That's where most of the growth hinges on. I don't think it is impacted so much by what happens within United States or globally, because India largely has not been a great exporter, at least not in goods. Its share of global exports is just around 2%. So even if that 2% now in the new regime falls to 1.5%, 1%, it's not going to be a make or break. What's going to be make or break is how much jobs are we creating internally within the country. The phenomena of rising on the basis of exports growth, China did it. I don't think India had plans to do it ever, and I don't think that's the plan for the government even now.
Fair enough, Anurag. In fact, as you point that out, in fact, I'll come back to you on that particular aspect that you have spoken about. But David, coming back to you, given, Powell has insisted tariff effects are short-lived, which you were also putting into context, but is this a blind spot? Could a protracted trade war under Trump keep inflation sticky and perhaps tie the Fed's hands, if that's one way to look at it?
You could say that, but I honestly think the trade war and what the Fed does is different. The only connection between the two is that India is in the crosshairs of Trump and the Fed is in the crosshairs of Trump. So the two of you, in a sense, are sitting in a trench while Trump thinks of new ways to actually launch a missile into that trench. That's the commonality, but otherwise there's not a huge amount of commonality. I think the implications of what the Fed has done. Look, let me put it like this in terms of why I disagree, which doesn't mean that I'm right. It just means that I disagree. One is on the labor market, the curious balance. He arrives at this conclusion by saying that, the labor market, the supply is contracting because Trump is throwing out all the immigrants, and the demand is contracting because the economy is actually not growing in a way which generates enough jobs. That's his argument. And he says if we go forward into the future, that curious balance could actually tip into creating a lot of unemployment. Now, how would you get to that reasoning? You would get to that reasoning by saying, well, Trump is going to stop throwing out the immigrants and the economy, so the supply side is stable, but the demand side for labor continues to go down. Then arithmetically, you get 5% unemployment, not 4.2. Okay, so that's where he says he is. Now, there's no grounds for that. That is just pure fiction. There's no earthly grounds to think that the growth of the US labor market supply side is suddenly, going to stop shrinking. Because to do that, you have to say Trump is going to stop his radical anti-immigration racist policies, and he's not. So I disagree with that. The second thing I disagree with is Powell reasons that tariffs will have a temporary effect on inflation, but not a longer-term effect on inflation, because he says, the labor market is too fragile to pass on the increase in prices coming from tariffs. I think that is totally irrelevant. What is really relevant is the fact that the US is trying to set up a nationalistic economy to replace a globalized economy. The globalized economy is productive, efficient, and low inflation. The nationalized economy is unproductive, inefficient, and high inflation. So I would say that transformation, which is a negative transformation, will take 5 years, not in 5 months. So I disagree with him on tariffs having a temporary effect as well. And then, of course, in conclusion, by taking the two statements, you end up with the need to reduce interest rates. And he says that interest rates are too high. The monetary policy is restrictive. I don't find that. I find that the R asterisk, the famous natural rate of interest at which the US economy is generating full employment and absolutely universal happiness, that natural rate of interest is pretty well where we are. And that's a huge difference. So Powell says where the interest rates are creates a national need to lower interest rates. And I say, prove it. I don't believe that. So that's why I differ. And I differ with respect and humbly, and I'm not the head of the Fed, and I probably will be wrong, but that's where I'm coming from.
All right, fair enough. Given the aspect of the strong words also that you put into perspective, why you believe, your differing view as well, David. But Anurag, let me come to you. One of the implications, or rather immediate effect that we have looked at over here after that speech is that gold is advanced as the dollar and the bond yields, in fact, have tumbled after the speech. But if you're looking carefully, it has opened the door to an interest rate cut in September, pointing to his speech, just those comments, to rising risk for the labor market, even as worries, of course, over inflation remain. And for Indian households, the gold demand, of course, is already strong. In a sense, how are we looking at this? What is your purview?
Nivedna, it is interesting. You keep referring questions around India to me, although both of us are sitting in Chicago, right? So, I just want to quickly comment on. By the way, hi David. So it's great to see you. But it's interesting. Look, there is the other side of it, right? What Chair Powell was stumped, and what everybody got stumped, was the jobs report that came out last month. Okay. And when in an economy for the last 4 years, at least in the Biden administration, the government spending was creating, about 40 to 50 to 60%, depending on the month. Jobs were being created mostly within 2-3 sectors: hospitality, government, public welfare, hospitals and government spending, basically, right? So around that. Now that goes down. And add to that the deregulation and the lower taxes, which have got extended, and some other incentives that, you can write off the entire R&D expense in first year and all of that, right? Those are the 3 legs of the current economic policy of the current administration. Now, in a jobs report that says 180,000 jobs were created, and then the next month it corrects and says, only 15,000 were created. Nobody can rely on those numbers. Right. And that's what I think Fed was relying on, that if the economy is strong, why should we cut? But as the labor market starts to weaken, somewhere I think Fed would have been too late had it not decided to cut rates now. So my limited humble view, again, I also might be wrong. But the point is, Fed was being overcautious, having done that mistake in 2021 of moving too late. So this is a welcome move. I appreciate that totally. Nivedna, can you reiterate your question about impact on India? I couldn't see the connect when you framed it.
Right, Anurag, although I could have done that, I'm afraid we're running short of time. And also given the aspect as to how we've looked at this, I want to thank you as well as David for joining us on the show this evening. But having said that, we hope that we get another opportunity to be discussing this and a lot more further. But for the moment, time for a quick break here on Business at 9. Stay with us this evening. We'll be right back with lots more on the other side.